Hi, hello there, good morning everyone, or whatever time you're watching this video. So welcome to the tutorial this week. Let's just jump into it. Associates. On the 1st of January 20x1, I will be making some notes as we go through the question. I would advise that you also do the notes as you are reading the question. So I noted that this is the acquisition date, always important to note. JAG Limited purchased 25,000 ordinary shares in MAG Limited. By this statement, I discovered that JAG is the holder and MAG is the associate. They acquired the shareholding for 30,000 current units, and that is my consideration, on which date MAG's equity consisted of 100,000 ordinary shares. And by that, I already know that if there are 100 ordinary shares, 100,000, and I hold 25,000, that means effectively I hold 25%, right? And the retained earnings was 40,000. And it's important for me to know that the share capital balance and the retained earnings at acquisition is my very important starting point for my AOE, right? And then I was given the trial balance at the 31st of December 20x5. Great. And then another thing I would want to note is that retained earnings relate to the 31st of December 20x5. It's always important to note which date retained earnings is referred to, because you can be given a trial balance for the year end, but only to find that retained earnings is for the beginning of the year. So it's just always important to confirm. So we've already confirmed, great. And then we're told that there was a plant at acquisition which had a cost of 700,000 and at the date of acquisition, and it had a remaining useful life of 9 years, but the fair value was 720. So we will do a check to see if the fair value equated, if the carrying amount equated the fair value, because we must record everything at acquisition at fair value. So let us test. We say the cost, to find the carrying amount, we'll say the cost over 10 years times the remaining useful life, and we get 630,000. That is the carrying amount. And then we are told that the fair value is 720. So we already know that you are going to have an adjustment of 90,000 being 720 minus 630,000, which gives you a difference of 90,000. You will see that 90,000 in your solution. You see, you are already collecting marks while you are reading the question. And then we're given how the retained earnings balance at 31st of December 20x5 is arrived at. So it was the opening balance for the current year is given 250. Again, you should note that for my since acquisition in the AOE, my growth in retained earnings is gonna be the retained earnings in current year, which is 250 in the beginning of the current year, minus the retained earnings since acquisition, which was 40,000 given there on top, and then your growth in retained earnings will then be 210,000. You will see that in the AOE. And then dividends were declared by MAG 10,000, and we know that 25% went to us as JAG, which is 2,500. You will see that amount in the AOE when we go to the solution. And you're also given the statement of comprehensive income, how comprehensive income was derived. And then what I noted there, it's important to note that only this portion will make it to the equity accounted financial statements, because we are equity accounting and not adjusting. So in our equity accounted statement of comprehensive income, we will not include the amounts from MAG, but only JAG's line items. And then we are given that profits before finance included the following: finance cost include the following items of revenue, and it was revenue from the actual sales plus the revenue from dividend income. Again, this was what you were required to do for revenue disclosure, and yeah, only the portion of JAG will show. You will also see when we are doing the solution. And then you're given that there was a long-term loan in between the companies, but then this is intragroup, but we don't eliminate it because you are not consolidating, but you are equity accounting, right? I hope you do understand why we won't eliminate that thing. There were no movements in share capital. There were no other intragroup transactions, and all amounts are material. And the corporate tax rate is 30%. Always important to note. Don't always assume it's 28%. Read the question. Required, we are required to prepare the equity method journal entries, right, for the year 31st December 20x5. Also for the same year, the equity accounted statement of comprehensive income, the equity accounted statement of changes in equity, and the equity accounted statement of financial position. Comparatives are not required. So I tell you in the notes, always ascertain this. Always show comparatives unless otherwise stated. That also goes for your term test 1. Some people did not show the comparatives, but it was not stated that they are not required. Okay, guys and girls, get ready. We are going to the solution. Okay. Oh, guys, just for an announcement, question 1, you are required to do question 1 and 2, but question 1 was just for submission, as we told you that you will not know beforehand which question is for marks. So this one was not for marks, and we are not going to do it, but it will be just for your self-study. You will get the solution, but I'm not going to discuss it. So our focus was question 2. Your first step, if you are dealing with any required for an associate, just first do the AOE. You all know how to do the AOE. So do the AOE and then use the amounts from there to answer the required. So the share capital at acquisition, that's your first starting point. The return, you bring in your retained earnings, your share capital, and the difference. We already calculated this when we were reading the question, 90,000, and we adjust for deferred tax, right? The tax rate is 30%, and then we get the total net assets at acquisition multiplied by 25% to get our portion, correct? And then we calculate the goodwill or gain on acquisition. Important, we don't really have a goodwill when it's an associate. Hope you guys know that. So the cost of the investment is 30,000, but our actual holding of the total value is 50,750. So you can see that we bought it for less than what is worth. So we made a bargain purchase of 20,750, and you will see that amount in our journal. And then since acquisition, we already worked out this 210,000 while we were reading the question, is the growth in retained earnings. And then you calculate 25%, which is our portion. Because you had an adjustment at the beginning of the extra depreciation increase in the fair value of plant, you have to depreciate it. And then it's 4 years, it's a depreciation 90,000 divided by the remaining useful life times 4 years. Why 4 years? Because this portion relates to since acquisition to the beginning of current year. So the 4 years will be from the 1st of January 20x1 to the 31st of December 20x4 to the beginning of the current year, right? That will be 4 years depreciation for 4 years, and then you adjust for the lower tax due to the depreciation, 40,000 times the tax rate. You get the net amount, you take and then you work out our portion, right? That is the adjustment due to the extra depreciation. Profits for the current, and then you go to current year, right? In your AOE, current year profit was given to you as 120,000. Our portion 25% is 30,000, and then you adjust for similar principle like above, just that now it's for 1 year, right? And then the dividend was declared of 10,000 and our portion was 2,500, right? Did you notice? It's important to read for pleasure, but it's also very useful. Okay, pro forma journal entries. So for pro forma journal entries, your golden account is investment account, investment in associates. So in this case is investment in MAC. So whenever there is an increase to an investment, you debit the increase and you credit retained earnings. Whenever there is a decrease, you debit retained earnings and you credit the investment. So there was a bargain purchase at the beginning, 20,750, and it increases our, this was the bargain purchase, right? It increases our retained earnings and it increases our investment. So debits the investment account, credit retained earnings. Number 2, it was our share of the since acquisition profits. The profits increase our investment and they increase retained earnings of the associates. So it's a debit investment, credit retained earnings 52,500 on our portion. This is the 52,500, right? And then retained earnings of associates. It debits the retained earnings of associates, credits investment in MAC. Why? Because it's the other way around, because the investment is decreasing here. You see how we calculated the net 7,000. So it's decreasing our profits. So the journal is the inverse, 1,750. Oh, pardon me, we are here since acquisition, that is your 7,000. Okay, and then and then coming to the current year, we made a profit of 30,000. So it increases the investment, debits investment in MAC. Instead of me crediting retained earnings, I credit profit and loss because this refers to current year, 30,000, and then this is the 30,000 in my AOE. See that everything becomes easy if we've done the AOE. What's the next one? I debit profit and loss, credit investment in MAC. Again, it's an inverse. Why? Because this 1,750 is decreasing my investment. It's not a positive. So that's why I am crediting the investment instead of debiting it. And then the dividend income, we eliminate it by debiting dividend income and we credit the investment in MAC, 2,500, and we already calculated it here. It decreases our investment, so that hence we are crediting the investment and not debiting it. Okay, in my next recording, that was all for the channels. In my next recording, I'm gonna do all the financial statements required B, C, and D.